John, great to have you on the program. Let's talk a little bit about where we go from here. You talk about the fact that the Fed can probably avoid a hard landing, but probably is looking at a bumpy landing. What does a bumpy landing look like for the S&P?
Thanks for having me on, Guy. I got to say, a bumpy landing looks like just like we're having right now, in the sense that if this is analogous to landing a commercial aircraft, we're down from 40,000 feet down probably around to 30,000, 20-some thousand, and we're experiencing some turbulence, okay? A little bit of extra turbulence than the type of turbulence you usually get coming in, but for business travelers, nothing unexpected. Like going into the City of London airport, you know, when you catch a little bit of turbulence, nasty kind of stuff. But my thought is here, what we've got is we're in the process of seeing the Fed do what it does best, which essentially is address its benchmark rate that already finished the taper. And now it's taking a glance at how much it's going to raise, trying to estimate that. Plus, it's keeping an eye on the balance sheet to start really reducing that. We do think that the real thing that has to happen here is it's the price of energy that's the problem, because it feeds everything in our economy. It's no secret. I mean, our clothes, the food we eat, the buildings behind me, everything runs on energy.
Right.
And as a result of that, we think the administration needs to pivot on this very hardline policy it has towards fossil fuel. There's a gap between fossil fuel dependency and the new world of alternative energy. Yeah. We believe in global warming. We invest in alternative energy, but we think it's too early to abandon fossil fuel.
So, John, I mean, that would take a whole recalibration from shareholders in particular to give the green light for industry to pump more oil. As an investor, though, if you were betting on energy in the last month, you were up versus every other sector. How do you invest with that thesis?
Well, related to in terms of energy itself, in terms of the share price, it's been extraordinary what energy has done over the last 2 years up to now. When you consider that it is still, I think, the worst performing sector since the peak of the S&P in October of 2007, before we really entered the financial crisis in depth. And it's a smaller segment of the S&P than it was in prior eras. It just happens to be of great importance right now because of all the disruptions that have been caused, some by policy here in the U.S., policy abroad in Europe, and of course the incursion by Russia into Ukraine, and of course just the general effects of demand from China initially coming out of the crisis, then drop off. There's all kinds of turbulence there. But we'd say the administration needs to pivot. And we don't, the Fed pivoted. There's nothing wrong with pivoting. Yep. When we talk to people in the oil industry, they say, why should I invest if I'm going to be put out of business? Mm-hmm. That's what this administration wants to do. And the reality is...
Every CEO, John, we talk to says exactly the same thing. They're also looking at really super high costs right now. Why should I invest when sand is so expensive, when labor is so expensive, and in a year's time, we could see things changing massively. Can I just take you back to the issue of the balance sheet, John, just for a moment? QT is coming, starts tomorrow. We've seen QE suppressing volatility. We've seen QE boosting asset prices. How are you thinking about the impacts that QT is going to have? Are we going to see increased volatility as it kicks in? Are we going to see lower asset prices at the moment? Have we already priced some of that in? Are we going to see a bigger impact now that it's starting?
I think without a doubt, we've already begun to see it be priced in with the dramatic move lower that we've seen in equities this year from the start of the year, and the increased volatility on a day-to-day, week-to-week basis. We've got to think that going forward now, it will really be, we'll be able to judge it not on expectations, on modeling of what's coming forth, a lot of projections, which tend to be negative in their effect, but actually taking a look at how it comes across the plate when the Fed starts moving to do this. And in the process, of the Bernanke legacy, which is part of Powell's Fed, this is a much more clear Fed. It's communicative, it's sensitive, and it's not afraid to pivot. You know, the word pivot is operational here. It's the key word. And it means the most important thing is to respond. But if you see your response is wrong, opt to pivot.
So, John, based on that, how do we know if yields have peaked? As of last week, it felt like maybe yes. And then we get this really chunky move in the bond market. We have the potential for more 50 basis point hikes to come. I understand your pivot point, but how do you know how to invest if you don't know yet where yields are supposed to go?
Well, I think what you've got to figure here is what had we before? We had a world of abundance. In fact, we had overcapacity in a vast number of industries. The function of shuttering large segments of the economy over the course of the pandemic threw everything out of kilter. The whole work from home business, the idea of the resignation, a lot of people resigned and retired early, a lot of turbulence here, but things are likely to go back where we came from. Because last we looked, there still is every bit as much natural gas under the crust of the earth as there was before the pandemic. And, you know, plenty of oil to be had.
John, final quick question from me. I just want to make sure that I've got this right. Your year-end target for the S&P is 53.30. Is that correct? And if it is correct, how do we get there?
Well, Guy, first of all, when we put that in, it was December of last year, and it implied a 13% upside from that. We couldn't foresee the incursion into Ukraine by Russia and the Chinese policy in terms of the lockdowns. But what we will say is the last time we saw a market that was in the process of coming out of a crisis, which was 2009, the S&P declined 25% from January to March of 2009. It then rallied 64% to the end of the year. If we get half that this year, I'm at my target.
Okay, so you still think that target is possible?
Oh, it absolutely is possible, but it's also very possible I may have to trim it. We'll know that in the next few months.